In How the Republicans Engineered the Stock Market Crash of 1929 and the Financial Meltdown of 2008, Laval University economics professor Bernard C. Beaudreau draws important parallels between the stock market crash of 1929 and the recent financial meltdown of 2008. He argues that in both cases the market was not to blame, but rather government was. Specifically, he argues that both resulted from unsuccessful Republican policy measures aimed at increasing aggregate expenditure. The first of these was the Smoot-Hawley Tariff Bill of 1929, aimed at securing a larger share of the U.S. market for domestic firms. The bill was defeated in the Senate on the eve of the stock market crash. The second was financial deregulation, aimed at increasing household credit and in the process stimulate weak aggregate demand throughout the 1980s and the 1990s. His line of reasoning goes as follows. The early 20th century witnessed a massive technology shock that increased potential output by over 50%. The electrification of the U.S. economy raised potential output markedly. Income and expenditure, however, lagged behind, owing in large measure to the fact that wages failed to rise, and profit income was and continues to be a residual form of income. Hence, higher productivity failed to be translated into higher income and expenditure. Beaudreau refers to this as the concept of under-income. Ranking Senate Republican Reed Smoot of Utah, chairman of the powerful Senate Finance Committee, acknowledged this problem and proposed a solution in the form of yet another round of tariff hikes. His idea was simple. Raise factory utilization rates by closing the U.S. market to foreign imports. This became the main economic platform of the Republican Party in the 1928 presidential election. In November, Herbert Hoover was elected on a platform of higher tariffs on manufacturing. Stock prices soared on the news that tariffs would rise and U.S. producers would enjoy greater sales. Not everyone agreed. Democrats opposed higher tariffs on manufacturers. But the key element in Beaudreau's story is a group of Republicans that became known as the insurgent Republicans. These were Republican senators who vehemently opposed the proposed tariff hikes. Ignored by Smoot and the Republican administration, they broke with the party in July of 1929 and joined ranks with the Democrats. The insurgent Republican-Democrat coalition vowed to lower, not raise tariffs. Smoot felt that their concerns could, however, be addressed. Investors were less hopeful. On the 21st of October, the very day of the first stock market crash, the insurgent Republican-Democrat coalition won its first Senate victory, reducing the tariff on tannic acid. The writing was on the wall from that moment on. Smoot's plan to firm up product markets was doomed. Investors realized this. Stock prices collapsed. Interestingly, they returned to their pre-tariff policy level. In other words, the market simply had factored out the anticipated gains from higher tariffs. The parallels with the financial meltdown of 2008 are eerie. The 1980s and the 1990s witnessed two important structural changes in the U.S. economy, namely factory automation and outsourcing. Both combined to lower the ratio of wage income to overall income. Firms that replaced workers with control technologies lowered their variable costs, as did those who outsourced their activities to low-wage countries. While these strategies were profitable for the firms in question, they were catastrophic for the economy as a whole, as they reduced purchasing power. As profits are a residual form of income, it stands to reason that throughout this period, income and expenditure weakened. Product markets followed suit. This raised a fundamental policy issue, namely how to address weakening product markets. With the death of Keynesian economics came a new set of challenges. For example, the Reagan administration could no longer turn to fiscal policy to stimulate product markets, nor could it turn to monetary policy, as it had already targeted inflation with high interest rates. In short, it was in a policy bind. What was it to do? Beaudreau argues that it opted for financial innovation aimed at providing Americans with easier access to household credit, defined as mortgage credit and consumer credit. And so began a series of policy measures aimed at increasing household debt and consequently stimulating consumer spending. Ironically, as consumers' ability to assume debt was on the wane owing to the falling wage share, they were called upon to bolster sagging U.S. and indeed world product markets. Among the key policy measures were the Garn-St. Germain Depository Institutions Act of 1982, the Secondary Mortgage Market Enhancement Act of 1984, and the Graham-Bliley-Leach Act of 1999. The result? Household credit soared. U.S. and world product markets strengthened. In fact, the results were better than expected. The resulting housing boom generated unexpected gains as homeowner wealth soared. Americans felt richer. Banks responded by offering easy access to home equity loans, which provided further stimulus. The problem, as Beaudreau points out, is one of sustainability. Consumer credit cannot, over the long run, be used to keep the economy afloat. For a quarter of a century, household credit soared on the strength of housing prices. Not only was this a tenuous situation, it was clear that it could not go on forever. When the bubble burst, this house of cards came tumbling down. Hence, in both cases, unsustainable Republican policy measures were the ultimate cause, not the market. For more on this, get How the Republicans Engineered the Stock Market Crash of 1929 and the Financial Meltdown of 2008, available at all good booksellers and Amazon.com.